We have three investors: Thomas, Bobby, and Simon. Thomas, Bobby, and Simon each have an emergency fund of 3 to 6 months of living expenses saved up. Now, they want to put the additional savings they take home every month into the stock market. Each investor saves $200 a month for 40 years. They all want to invest this money in a low-fee S&P 500 index fund, but they each have different strategies for how and when they choose to invest it. Since no one knows how the stock market will perform over the next 40 years, we will look back at how the S&P 500 has performed over the last 40 years. Between 1979 and 2019, the U.S. stock market experienced four major market crashes. Now that we know how the market has performed and how much our investors are investing, let's see how well each investor would have done. First, we'll pay a visit to Thomas. He doesn't really understand the concept of buy low and sell high, and as a result, Thomas has terrible timing with his investing. He puts $200 a month into his savings account, but whenever he sees the stock market climb to an incredibly high value, he worries he'll miss out, so he invests all his money into the S&P 500. Thomas manages to unfortunately time his investments perfectly with each of the four market peaks. Next, we'll look at Bobby. He has incredible timing, and as a result, Bobby always buys at the bottom. He puts his $200 into his savings account each month, but whenever he feels the stock market has bottomed out, he dumps all his money into the S&P 500. He incredibly manages to time each of the four crashes perfectly, investing all of his money at the absolute bottom. Last, we have Simon. He values his time and doesn't want to spend a large chunk of it researching trends and constantly monitoring his investments. As a result, Simon decides to go slow and steady. He chooses to set up his account to have his $200 automatically invested into the S&P 500 every single month. He never looks to see how his account is doing because he knows it doesn't really matter since he still plans to invest the $200 no matter what. He doesn't worry about crashes or peaks because he knows he is in it for the long haul. So the question is, at the end of their 40-year investing period, who comes on top? Let's find out. Even though Thomas invests his money in the stock market at each of the four peaks, he still manages to turn his $200 a month over 40 years into a respectable $663,000 in 40 years. If he had chosen not to invest in the stock market at all and simply put all of his money into a savings account, he would have ended up with less than a third of that amount. So even though Thomas invested at the worst times, he's still better off than if he had chosen not to invest at all. Bobby manages to achieve what we all hope to do. He saved up a stockpile of money until the stock market bottomed out and then dumped all his cash into the stock market at the absolute best time. In 40 years, Bobby's $96,000 turns into an impressive $956,000 thanks to his perfect timing. Finally, we have Simon. He takes a much less stressful path by setting his account to automatically invest his money into the stock market during the course of the entire 40 years. Simon doesn't worry about market dips or peaks. He doesn't even look at his balance until he's ready to cash out. This passive strategy led Simon to turn his $96,000 investment into a whopping $1,385,000. In the end, investing in the market consistently over time was the best strategy. But Bobby invested with perfect timing, so why didn't Bobby beat Simon? Though Bobby spent countless hours studying and timing the market perfectly, he somehow overlooked the most critical knowledge of all to being a successful investor over the long haul. Some investors call this knowledge the eighth wonder of the world, and that is compound interest. While Bobby was stockpiling his cash, waiting for the absolute perfect time to buy, Simon was consistently putting in $200. Each month, Simon was earning interest on the money he was putting in. Month after month, Simon's money was effectively multiplying, while Bobby was keeping his cash on the sidelines. To make matters worse, Bobby let his money lose value by holding it. Since inflation makes money less valuable year after year, Bobby ended up investing money from years ago, which effectively became less valuable. The lesson here is any money you have today will be worth so much more to you in the future if you choose to invest it consistently and frequently. Don't worry about the headlines or speculating on how the markets are going to perform. If you stick to the long-term investing strategy and can ignore what you hear about the market on a day-to-day basis, you will be putting future you in the best possible financial situation without all of the headaches.